When it comes to managing the economy, governments have two powerful tools at their disposal: fiscal policy and monetary policy. These are very different approaches, each with its own strengths and weaknesses. Let's start with fiscal policy. This refers to how the government manages its revenue and spending. If the government wants to stimulate the economy, it can increase its spending on things like infrastructure projects or social programs. This creates jobs and injects money into the economy, which can help businesses and individuals. On the other hand, if the economy is growing too fast and inflation is becoming a concern, the government can reduce its spending and increase taxes to slow things down. This can help prevent the economy from overheating and reduce inflation. Fiscal policy is implemented by the government through the budget process. This means that politicians have a direct role in deciding how much money is spent on different programs and how much revenue is raised through taxes. One of the advantages of fiscal policy is that it can be very targeted. For example, the government can increase spending on education to try to improve the long-term prospects of the economy. This can also have social benefits, such as reducing inequality and improving access to education for disadvantaged groups. However, fiscal policy can also be slow and cumbersome. It can take a long time for governments to pass budgets and allocate funds to specific programs. This can make it difficult to respond quickly to changing economic conditions. This is where monetary policy comes in. Monetary policy is the management of the money supply and interest rates by the central bank. The central bank can influence the economy by adjusting interest rates, which affects how much it costs to borrow money. If the economy needs a boost, the central bank can lower interest rates to encourage borrowing and investment. This can help stimulate the economy and create jobs. Conversely, if inflation is becoming a problem, the central bank can raise interest rates to make borrowing more expensive. This can slow down the economy and reduce inflation. One of the advantages of monetary policy is that it can be implemented quickly. Central banks can make decisions on interest rates relatively quickly, which means they can respond to changes in the economy in a timely manner. However, monetary policy can also be blunt. It can affect the entire economy rather than just specific sectors. For example, if the central bank raises interest rates, this can make it more expensive for businesses to borrow money, even if they are not contributing to inflation. Another challenge with monetary policy is that it can be difficult to predict how it will affect the economy. Interest rates are just one of many factors that influence economic growth, so it can be hard to know how a change in interest rates will play out in the real world. In summary, fiscal policy is all about managing government spending and revenue, while monetary policy is about managing interest rates and the money supply. Both approaches have their strengths and weaknesses. Fiscal policy can be very targeted and can have social benefits, but it can also be slow and cumbersome. Monetary policy can be implemented quickly, but it can be blunt and difficult to predict. Ultimately, the effectiveness of these policies will depend on the specific economic conditions they are trying to address. By understanding the differences between fiscal policy and monetary policy, we can better understand how governments and central banks are trying to manage the economy and how these decisions can impact our lives.